Welcome to the Kapital News. I am your host, Alex Karitis. Today is July 17th, 2019. Thank you so much for joining me. Earnings Season Train Wreck, the title of today's episode. While it's early in this season of earnings for reporting second quarter, we're not getting those spectacular numbers that a lot of people on Wall Street were hoping for. Now, we've been saying here all along that we are anticipating that there is going to be an earnings recession, at least a slowdown in earnings. This has been talked about. This has been discussed on this podcast. It's been discussed in the mainstream media. However, people are still clinging beyond hope that everything is going to be A-OK. And it very well may prove to be A-OK throughout this earnings season. However, we got some mixed data over the past couple of days. Yesterday, the markets were relatively flat. I know I wasn't on yesterday. My apologies, but I'm back tonight. So today, a little bit of a different story. A little bit more of a sell-off today in today's markets. The S&P lost 20 points, representing a decline of 0.7%. The Dow lost 116 points. The Nasdaq lost 38. The Russell 2000, the small cap index, lost 11 points, also representing a decline of 0.7%. The Dow Jones Transports lost a whopping 390 points, representing a loss of 3.6%. 3.6% decline. The New York Stock Exchange was also down, losing about 0.6%. We're going to get into this. Oil is trading lower than where it was the other day when I last had a podcast. It is now trading at $56.70 a barrel for WTI. Brent crude, the international metric, is now trading at $63.80. The precious metals markets caught quite the bid today. Gold rallied over 1% earlier in the day. It now trades at $1,424 an ounce. Silver gained over 2%, now trading at $16.14 an ounce. I've been saying here, ladies and gentlemen, for quite a while, buy low, sell high. That's what you're supposed to do. I still believe both of these precious metals are undervalued, particularly silver. I still think these prices are low. Uncle Sam's U.S. 10-year Treasury shed 3 percentage points. It is now yielding 2.061%. It still has that 2 handle. The VIX, the volatility index, gained nearly 9% for the day and now trades at $13.97. So the reason for today's title, Earnings Season Train Wreck, of course that's a question mark because we're not done with it, is because of the Dow Jones Transports. Now, yesterday, there was quite the rally with the Dow Jones Transports, rallying, I believe it was over 1%, might even have been 2% at one point during the day. But nevertheless, it gave all of those gains back and then some, and again, losing 390 points, representing a loss of 3.6% for the day. Now, I did catch a little bit of CNBC last night when I got home, and one of the topics of discussion on yesterday's show, again, not tonight's, but yesterday's, was the Dow theory. And that's simply focusing on the Dow Jones Transports. That's one of the main reasons why I added this to the list of our daily rundown when we go through the stock market and through other financial assets. Because the Dow theory holds that the transports are a leading indicator. These are the companies, land, sea, and air, that are moving people and packages, goods and services from one point to the other. And so it's very logical and very rational to assume and conclude that if there's higher volumes, there's a healthier, more vibrant underlying economy. When there's lower volumes, stands to reason that the economy is slowing down. Well, interesting, yesterday on CNBC they were having a discussion. Well, the Dow Jones Transports are up, so does that mean that the broader stock market, that the other major indices are going to carry the way? Are they also going to rally higher? First off, one day does not make a trend, and this goes to the point of following the financial mainstream media. It's all about headlines. Nobody wants to take the time to look at some of the underlying data. It doesn't take that long, folks, but that's what we do here at the Kapital News. We look under the hood. We don't just focus on the headlines. One day does not make a trend. That's why when we had this conversation last week, I believe it was, and maybe even the other day, because a lot of this is continuing. This is something that I'm going to be continuously talking about as we make our way forward, because I am now starting to focus more heavily on the bigger economic puzzle pieces that are going to paint a more vivid picture as we move forward. But the topic I'm talking about here is, of course, the Dow Jones Transports. One day does not make a trend. Neither does today with its sell-off. That's why we looked back 18 months. And I chose 18 months because we had some of the most, recent highs. Obviously, we continue to make recent highs. But prior to this, we have to go back to January of 2018, when you had a lot of the major indices making a high. Okay? So we're going back 18 months. We're looking at January of 2018, and we're carrying out the S&P 500, its performance, and we're tracking that with the Dow Jones Transports. And what I mentioned the other day was, during this time period, we have never seen a divergence of this size and of this duration between the S&P 500 and the Dow Jones Transports. They're usually trending in line with each other, give or take a couple percentage points here or there, if that. We are now at a wide gap for a long duration, with the Dow Jones Transports well below that of the S&P 500. If one is to conclude that the Dow theory still has legs, then one would have to conclude that the S&P 500 is going to trend lower to meet with the Dow Jones Transports. Now, of course, there can be some wiggle room, some meeting in the middle. But nevertheless, if you're going to look at this as a leading indicator, the S&P 500 would go down to meet the Dow Jones Transports. This was not mentioned yesterday on CNBC. It was, they're up today. Does that mean the stock market's going up tomorrow? That is not an intelligent conversation to have. That is a disservice to the viewers. Now, some people who are educated and understand this, one day does not make a trend, but a lot of people don't understand this. They might be turning on the news, trying to educate themselves, trying to pay attention to the quote-unquote experts. That was a huge disservice, because what are people supposed to think? They turn on CNBC yesterday, the Dow Jones Transports is up 2%, now today it's down 3.5%. What's one to conclude unless you look at data over the course of a year and a half? Something that paints a picture. Doesn't take that long, folks. CNBC has the data. They have the producers. They could have simply throw up a chart up on screen and say, well, look how they've trended over the past 18 months. We've never seen this type of divergence. What do you think is going to happen? And then you have a discussion amongst the investors and traders that they have on their various programs. It's not that difficult. That's why we look under the hood. We don't just pay attention to the headlines. There's more to it than that. But sometimes headlines is okay. That's all you got, or you just want to run by them. We run by headlines here too. But then we go deeper into the story in subsequent podcasts. We talk about how things are puzzles to this economic puzzle. What's the picture? What are we looking at here? What do we see now? What are we going to see in the future? Is it vibrant? Is it just a little sluggish? Is it just a hiccup? Or do we have structural problems? Well, you know my opinion if you've been listening to this podcast. We have structural issues, none of which are being discussed, none of which there is no solution from our quote-unquote leaders, whether that's with people within the Federal Reserve, whether that's people within Congress, whether that's the White House. There's no leadership. There's finger-pointing. There's kick the can down the road. Let's continue to do what we've been doing, which is solving absolutely nothing. So let's continue with some of this news, because some other things that we talk about here on a near daily basis is the price of lumber, copper, and aluminum. We look at these things as some leading indicators. And also with the trade war going on, can also send a little bit of a signal as to what might be transpiring. If we look at lumber is now trading at $327 per 1,000 board feet. Now, we don't have to get hung up on what the exact price is or anything like that, but where's the movement? What's the trend? We were talking here very recently that lumber made quite the rally over the past couple of weeks north of $400. Now, in a very short turnaround, it is trading well below $400 at $327. If we look at lumber as a leading indicator, and I advise you, get on a graph, find it. You can Google it, find it very easily. Go on Trading Economics. You can find a graph of lumber. you can put it up against a graph of the stock market. It does tend to lead the overall stock market indices. If you're going to have this type of slowdown and reversal in the price of lumber from north of 400 to well below 400, does that bode well for the stock market? Time will tell. We will see. But again, this is another piece of the puzzle that we want to pay attention to. Copper caught a little bit of a bid as well over the past couple of weeks, now at $2.70. This is on the back of a weakening dollar and some other disruptions, but nevertheless, it is also trending lower overall. Aluminum, however, while it's been trending lower for the past year and a half, I don't know if this is right now a bottoming process it's in, but it has also caught a little bit of a bid over the past couple of weeks, now trading at $1,850. Not too long ago, it was south of $1,800. So a couple of headlines we're going to get to here shortly, but before I do that, I want to go through some other things with the Dow Jones Transports just to break it down for you a little bit more clearly, because the Dow Jones Transports is an index that is only comprised of about 24 individual companies, okay? You got airlines, you have maritime transportation, land transportation, so you got truckers, you got tankers, you got airplanes, okay? It's not rocket science. So that's what we have. But today, where do we stand? If we're looking at Avis Budget Group, that's your car rental, they lost 1% today. You got Landstar Systems, another transportation. They lost 2.5%. Kirby Corporation, a maritime transporter, they lost 2.33%. Expeditors International lost 2%. Ryder System, another transportation, lost 2.4%. Norfolk Southern, a railroad, lost 7.5% today. CSX Corporation, another railroad, lost 10.33% today. 10.33%. We have a quote from the CEO of CSX. The Trump economy is the most puzzling in my 40-year career in the rail business. It's puzzling. Why is it puzzling? And he said this on a conference call to investors and analysts. So he's not hiding this. It's puzzling. It is puzzling. We're in the financial world of Oz. You have the president on one hand saying this is the greatest economy ever, and then right next door at the U.S. Treasury, you got Treasury Secretary Steven Mnuchin. Hey, Congress, yeah, I know he's saying that this is the best economy ever, and there's, billions and billions of dollars coming into the U.S. Treasury from all these tariffs, because he's tariff man and everything, but you guys got to get together and you got to vote real quick to raise the debt ceiling because we're running out of money. Yeah, that's right, we got no cash. Okay, so which one is it? Fantastic, or we're running out of money? Because I thought if everything was fantastic, you got a whole bunch of money. So why do we have to raise the debt ceiling? So we have more money. So we can borrow more money. Not produce more money. The government doesn't produce a damn thing. They produce problems that we all have to pay for. That's what they produce. Doesn't make sense, does it? So you have CEOs coming out and saying this is the most puzzling economy ever. And of course, he puts this against the backdrop of lower prices, lower volumes for rail. But then somehow when he's talking to a lot of their customers, some of them are actually cautiously optimistic for the second half, that there can be some sort of turnaround in the second half of 2019. I don't know what they're smoking, how they think this is really possible, but you know what? Maybe it is. Maybe it is. I always say I'm always willing to accept that I'm wrong. There's always smart people on both sides of the trade. Somebody's buying, somebody's selling. You never know what's going to happen. But if you're going to look at these things, if you're going to view these issues and these concerns as structural issues, not simply transitory, not something that's just, it's a little hiccup, little bump along the road, but if you look at them as a structural issue, which they most definitely are, we talk about it all the time, this is not going to get better until there is the necessary correction, which the president, the Federal Reserve, other federal governments, other central banks around the world all want to conspire, and they want to kick the can further down the road because they're all doing the same thing. Preparing to lower interest rates if they haven't already done so, and preparing for other rounds of quantitative easing, which is money printing. It's debt monetization. this kills the economy. This causes malinvestment. This causes people further out on the risk curve. That is to say, it makes people take risks that they otherwise would not have taken because they say, hey, Larry, I got all this free money. We can do something real stupid, but maybe we'll get lucky. That's what people do. That's what people have been doing for the past decade. When they've made mistakes, because the cheap money keeps rolling in, they just kick the can further down the road. They just get another loan. They get loans on top of loans. That's called a leveraged loan. And if you actually take the time to read the financial stability reports from the Federal Reserve, they're concerned about this. They might tell you that a little bit in passing, some of their press conferences, some of their statements before Congress, or some of their other speeches. But it doesn't get a lot of airtime. Because at the end of the day, they just say, well, we're monitoring this, but it's nothing to panic about. It's nothing to worry about. We have it under control. Take it easy. Go back to sleep, take a nap. Take another Prozac, take a nap. It's exactly what we were told with the subprime crisis. This is what then Chairman of the Federal Reserve, Ben Bernanke, said when asked, do we have a problem in housing? No, we don't have a problem in housing. And if we do, we'll contain it. Because subprime, it's such a small proportion of the overall housing market. How did that work out, Uncle Ben? Not too well. Not too well, you economic genius. That man should be arrested. Janet Yellen should be arrested. They have destroyed this economy. They have created an experiment. We read the quote the other day when we were going through quantitative tightening and how that probably has an effect, just like increasing interest rates. But the Federal Reserve is treating them as two separate things. Increasing interest rates is one thing, quantitative tightening, completely different. Yet in that blog that we were reading that was highlighting this, we quoted Janet Yellen, another former chairman of the Federal Reserve, saying, well, we've never done this before, quantitative tightening, so we really don't know what's going to happen. Does that sound good to you? Do you have a job? Do you have a house? You have a mortgage payment? You have a car? You have a car payment? You got school loans? You're trying to put your kid through school? You have medical bills? You have a life? And these people get away with this. We don't know what's going to happen, but we think it's the right thing to do. People got to wake up. This has a very personal effect on your pocketbook. This stuff doesn't just happen, ladies and gentlemen. It's easy to scapegoat and blame Mexicans and illegal immigrants. Oh, they're taking our jobs. Got to build a wall and get them out of here. Go back to where you came from. It's easy to blame the Chinese. They're several thousand miles away. They're taking our jobs. They're working for nothing. Does anybody want to talk about the problems that we've caused ourselves? The people that we elect as our quote-unquote leaders? Where have they led us? They've led us to slaughter. And as long as they use a few key words, justice, freedom, build that wall, we salivate like Pavlov's dogs. Meanwhile, we're taxed to death. Our currency is inflated away. Demographics are going to cause massive problems. Nobody's talking about this. We have nearly $23 trillion in national debt. Getting higher, no end in sight, nobody's talking about it. But build that wall, blame China, blame the illegals, point the finger at 4 lunatic women in Congress, play politics, further divide this country from both sides. I'm not pointing the finger at President Trump singly out here. Believe me, if I had started this podcast when Obama was in office, I would have had 20 letters written to that guy by now. But Donald Trump is the president right now. He has a lot of responsibility on his shoulders. I give the man a lot of credit for a lot of things. Those of you who have been following this podcast know this, but I also criticize him a lot too. And I do so because I think it's the right thing. Just because I voted for him doesn't mean I'm going to support him on everything he says and does. Far from it. I voted for him for some very fundamental reasons, a lot of which he's done a 180 on. So I don't like it. A lot of the other things that he may or may not be doing in regards to some of this two-tier justice system and maybe actually going after some people in Washington, D.C., that's what he's supposed to do anyway. I want to see some fundamental change. I want to see some true draining of the swamp. Is it going to be easy? Nope. It's not. But when you have a Goldman Sachs banker as your Treasury Secretary, when your former acting Secretary of Defense was from Boeing, and your current acting Secretary of Defense is from Raytheon, I got a problem with that. Military-industrial complex, anybody? Draining the swamp? I don't think so. Not even close. But let's blame the Chinese and let's blame the Mexicans. Look at yourself. Look at the policies we have enacted and implemented. What has been fundamentally changed? Absolutely nothing. Absolutely nothing. So we have the Federal Reserve expected to cut rates at the end of this month. Will they do it? Probably. What's interesting to note, again, is are they considering quantitative tightening? Does that have an effect, like increasing interest rates? So for the sake of example, if they continue with quantitative tightening, which they are supposed to do until the end of September, it's another couple months. If they continue to run off their balance sheet for another couple months, you could be talking anywhere from $20 to $50 billion, maybe even $100 billion worth of liquidity coming out of the system. So what are you going to have? What's your net effect going to be? Are they going to cut them by 25 basis points? But you're going to continue quantitative tightening? So you're going to negate the supposed effects of cutting interest rates. So it's basically like shooting yourself in the foot. You're not doing much of anything. Are they going to cut them by 50 basis points? Now, that would be bigger juice. But will that send a message to the markets? My goodness, we were anticipating 25 basis point cut now, maybe a 50 basis point cut later down the road, or another 25 basis point cut down the road. Is the Fed signaling that something's really wrong that we're not paying attention to? Now, you're likely to get a knee-jerk reaction from the markets that they're going to like it, because this is their monetary methadone, if you will. This is their crack cocaine. This is their shot of heroin. This is monetary juice for these people. They throw a hissy fit. Here comes the Federal Reserve. All right, we'll save you. We'll print more money. We'll get the stock market back up until they can't, until they don't. They've done this before, ladies and gentlemen. The market crashes or it pulls back. This is not a foolproof remedy. This is not a remedy at all. This is a Band-Aid on a bullet wound. The patient, the economy needs cleansed of the disease. This is putting more of the disease in the patient. It needs to correct. It needs to be flushed out. The malinvestment needs to be liquidated. That's what has to happen. These bad debts need to be wiped off. They need to go. These zombie companies that we talk about need to go out of business. They need to go through bankruptcy. I don't want this to happen. You understand? I don't want this environment to exist. But it does. Because we haven't taken this by the horns. We have not led this country. We have not been honest with the American people. Really, people around the world, because this is being done everywhere. Because you have now, we've talked about Christine Lagarde, the managing director of the IMF. Well, she resigned. Why? Because she's headed to the ECB to become the next president of the European Central Bank. And she's all primed and ready for more negative interest rates, which is so, you know what, backwards, it's not even funny. Negative interest rates. You give the government $10,000. Typically, you're expecting to get your $10,000 back plus interest. Now you're going to get less back. Negative interest rates. It is destroying the financial system of Europe. Destroying it. Some other quick headlines real quick before I sign off here for the night. Japan exports fall for the 7th month. Exports from Japan declined by 6.7% year-on-year to Japanese yen 6.58 trillion in June of 2019. Worse than market expectations of a 5.6% drop after a decline of 7.8% in the previous month. South Korea unexpectedly cuts its key interest rate by 25 basis points to 1.5%. This was not expected. Again, South Korea is a major exporter as well, such as Japan. These are bellwethers, folks. These are economic indicators. If they're cutting interest rates, they're concerned, just like everybody else is. They're trying to stave off what's coming. They are not going to be able to do it. Market forces always win out. You can only defy the laws of economic gravity for so long. And the problem is, the further out they kick this can, the worse it's going to be for everybody. Because they're making these bubbles bigger. Makes the burst bigger. Makes the problem bigger. Japanese imports fall more than expected. Imports to Japan declined 6.7% year on year. Markets were expecting a decline of 0.4. 0.4. They declined 6.7%. So the Japanese aren't selling, and they ain't buying. Not good. And of course, you read some of these articles, they want to continue to blame the U.S.-China trade dispute, which is ridiculous. It's a non-story. Japanese markets right now trading down 1.5% on this news. Earlier in today's trading, if we're looking at the European markets, the British markets were down 0.5%. The Germans were down 0.7. Same with the French. The Italians were down 0.5%. The Spanish markets were down 1%. And the Russians, they lost 1.5%. One day does not make a trend, but we are in the midst of earnings season. Is it a train wreck? We're going to keep you updated because we got a few more weeks to go. Thank you so much for joining me, ladies and gentlemen. Stay diversified, stay prepared, and stay tuned to the Kapital News. This is Alex Karitis. Godspeed.